I am out of the equity market, no different in a lot of respects than Warren Buffett, because the price is too high.
On WealthTrack, why retired Treasury bond maven Robert Kessler is totally out of the stock market and thinks you might want to be too.
Funding provided by Clearbridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. The markets are reminding us once again why stocks are called risk assets. They can go down. And there have been several periods in recent memory when they have gone down a lot. But talk to just about any financial advisor or money manager and they will tell you to stay invested, that stocks are the best place to be for the long run. Now, many of our guests share that sentiment with good reason. The U.S. stock market has outperformed other financial assets for most of the last century. This week's guest doesn't dispute the historical record, but he has a different point of view about it. It is the exceptions when the stock market enters a prolonged bear market that worry him. He is Robert Kessler, an annual guest on WealthTrack since our earliest days and one of our most popular ones. Until his retirement in late 2021, he was the founder and CEO of Kessler Investment Advisors, a manager of fixed income portfolios for institutions and high net worth individuals globally, with a specialty in U.S. Treasuries. Now, for decades, he has criticized Wall Street for its pervasive stocks for the long run thesis and dismissal of cash as trash in portfolios. In the last couple of years, he has sold his entire stock portfolio and put the bulk of it in cash and equivalents. I asked him why.
Let's start off by talking about the fact that equities right now, the multiple on equities exceeds, for the most part, almost every other period of time that we've seen excessive prices in markets where they come down dramatically. And when I say excessive, I mean very excessive. Now, it's true, AI has been spectacular in perhaps the last year. And it's true also that AI actually, in a lot of cases, are making money, which is a little bit better than the dot-com days, because those guys weren't even making any money. But nonetheless, everything is very, very high priced. I am out of the equity market, no different in a lot of respects than Warren Buffett, because the price is too high. I don't think it makes any sense for any of us, especially those people who perhaps might be reaching retirement, and I'm there. I can talk to you in a little bit different way, perhaps, than people who are selling you something. I am not selling you anything. What I'm telling you is that if you're sitting with other assets, those are things you're probably not going to sell. You're not going to sell your house. In my case, I live on a very nice piece of property in Colorado. I'm not going to sell it. But there are things I can sell. And those things are things that I can price. Now, in the equity market, as a matter of fact, they're simply overpriced. It's the first time we've seen Warren Buffett, and that I can remember. Well, that's not exactly true. I've seen him do that in 1974, too, when they were extremely overpriced. But right now, this man is sitting with the sage of Omaha with $320 billion. He's not sitting there just yesterday because the market was volatile. He's been sitting there for a little while. And the reason he's doing that is because he's saying he can't find any value. Okay, we have that option. When we listen to people saying, hey, everything's for the long run, remember, when you hear that, that is the first sign probably to start getting scared. I hate people who say things are for the long run. That means they're not working out today. And right now, people are saying, don't worry about the market going down, stocks go up. Well, that may in fact be true. As we all know, we're not necessarily going to be here in the long run. So I don't see any reason why you have to treat a stock in some special way because someone in Goldman Sachs tells you that. So I think we all have to sit back and decide ourselves whether we can go to sleep at night and think about our portfolio and feel comfortable. I personally, if I go to sleep at night and, oh, wow, I only lost 20%. I don't feel good. Well, wait a second, what about my other 80%? I'm not sure. So why not sell it? They're only equities. You're not going to hurt your family or anyone else. You can always buy these things back.
You've been on this program for on and off and regularly for 20 years. And for the most part, one of the things that you have told us is that the idea that stocks are for the long run is a fallacy, because stocks for the long run, we're talking about 100 years or sometimes 20-year periods or 10-year periods. But in a lifetime, stocks have also gone down for 10 or 20 or 30-year periods. So your point is that they are high risk, that you shouldn't buy that notion that holding them for the long term is something that we should do. And therefore, I'm surprised that you're making it now more of a market timing question than a principle that stocks are not necessarily best for the long run for everyone.
Okay, so maybe I'm maturing a little bit. So let me give examples for a moment. I started in the business in 1966, 1967, and the Dow was at 1,000. It took until 1981, 82, 83 to get it back to that same level. And I want to go back to 2010, not very far ago, far back. And in fact, that was just about the bottom of the last drop in the market. I want you to think for a moment of going into an antique store and buying a beautiful vase that you think is terrific, and you spend $2,000 for it. And I tell you today, right now, hey, you know what? By the way, you're on Antiques Roadshow, and the guy just said it's worth $20,000. You know the first thing we all do? We watch television, we do this. Sell it. Sell it. $20,000? Are you serious? That is exactly what the S&P average did in that period of time. That's 15 years. Now, there's nothing wrong with that. That is a terrific gain. It always strikes me that when you make a gain like that, it's not such a bad idea to say, I think maybe it's time to step away. I can always come back. Come on, it lasted 15 years. So there's plenty of time. But let me bring out another point. The market has been very volatile for all kinds of reasons, none of which we have to go into. But it's been very volatile, and it's difficult to sleep that way. Oh my God, what am I going to do? My stocks are dropping. This is my savings. Let me say something about that whole concept of markets dropping. You can always get back in, and let me explain why. Each one of the major drops that I can remember, and I'm going to go back again to 1967, each one of the major drops that I've looked at has lasted the drop at least a year and a half, 2 years. You have plenty of time to get out, and then plenty of time to look at it just like Warren Buffett's going to do and say, wow, I'm glad I'm out of there, and wow, this is good value today. And maybe that's going to be 2 years from now. But you won't be able to do that if you're sitting with your whole portfolio. Now, I know for sure that what your financial advisor is probably going to tell you is, well, if you can't sleep at night, why don't we just sell 20%?
Right.
Sounds good, but I've done it. I've done it. You're going to go to sleep tonight and you're going to say, well, glad I sold 20%, but then it drops another 5%. What about your other 80%? What do you sell, another 20? What is your advisor going to tell you? And I'm going to tell you why this doesn't work. Because your advisor has absolutely no vested interest, no reason to sell that whole portfolio. That is how the whole industry makes money. If you don't own anything, no one is making any money. You own a house, or you own some land, or you own something else. No one says you have to sit, my God, with a whole portfolio of equities. It takes time. Markets take time. It takes time to go down, and then you have plenty of time. My God, from 2010 to 2025, that market went from 2,000 to 20,000. What would have been the difference had you sold it all and you came in the middle of that? And I think that's the reason I think it's so important that you understand that you do have choice and you have opportunity. And one of the things I think that's most important is that you listen to people who really have a lot of experience. And those people, and I mean this is without exception, very, very well-to-do people who are in this market are out of it. Maybe they're buying something else. Maybe they're buying Chinese stocks. Maybe they're buying land in Europe, commercial real estate. But they're out of their equities because they're very expensive. They sell at a multiple that we don't get to see very often, and neither do you. So take advantage of it.
One of your points over the years and here is that we're not professionals, we're not in business, and therefore we do have these choices. However, if you look at the returns that the stock market has delivered over the long term, and again, depends on what the long term is and what your time horizon is, but stocks, the power of compounding that Charlie Munger and Warren Buffett have talked about, the power of reinvesting your dividends, if you don't interrupt that you can make more money than you can in investing in other financial assets, and you also are not subject to the whims of market timing. The problem is if people sell out of their stocks, for instance, they usually don't know when to get back in. So behavioral economists, behavioral finance experts have studied this, and individuals and professionals as well are notoriously bad at market timing.
I want to talk about other investments for a moment.
All right.
First of all, there are two issues. A lot of people have said, at least a lot of very smart people have said, better you give me my money back than tell me how much I'm going to make on it.
Will Rogers.
That was Will Rogers, as a matter of fact. Now, what's interesting about that is if all of your audience thinks back a little bit, we all complained that, my God, we could only get 0% on our money. How can I possibly go to the bank and get a CD at 0%? I remember the old days when you could get 5, 6, 7%. Well, you can right now. Let's understand the effect of compounding your money. If in fact you were getting 6% guaranteed, I mean, you can pretty much do that. Your money would double every 12 years. That's the effect of compounding your money. Go to sleep at night. I just retired. I think I may have 12 years to go, and I'll have double my money. I don't have to really think about whether the equities are going up or I can make 5 times my money. I'm done with that. I made my money in the electrician business or the painting business or whatever business you were in. How is it that we all have to be forced to give credit to people we don't even know and accept their knowledge when we don't know anything about it. Oh no, I think you ought to buy AI. I think that's probably terrific. But to buy NVIDIA right here might be a mistake. I don't know that, and neither do they, and neither do you. These are the whims of the market, but we're talking about absolutely guaranteed that my money will double in 12 years. And I think I'm going to retire. And I'm 65, so at 77, I'll have twice as much money. That's not a bad choice. You do have a choice. And that's the point I'm making. The whole concept of everything is for the long term. Well, what they mean by everything is for the long term, they mean equities, stocks.
Right.
That's what they're selling you. They're not selling you, wow, 6%. Over 12 years, you doubled your money. I don't hear anyone doing that. It's something we should at least think about.
I'm thinking about it, Robert. And I know our viewers are too, because so many of them have emailed us and said, get Robert Kessler back on WealthTrack. So here you are. But I'm still interested in the fact, it's a matter of current market valuations that you're talking about, that they're excessive. And also the fact that you're talking about you as a retiree and other people who are either close or in retirement, that the stock market is too expensive and therefore too risky to stay in, to preserve and grow your capital. Get your money back.
I am not suggesting that anyone shouldn't own equities.
Okay.
There's absolutely no reason why equities aren't part of people's potential portfolio. I'm simply saying there are given times that you can sell them. You are not married to this investment. What I'm saying is I'm very, very uncomfortable. A lot of people have compared this market to a lot of very, very bad markets, markets that have dropped. By the way, the average for this type of a market, when you get to this multiple of earnings, the average drop has been 50%.
Oh my goodness, wow.
That's a big deal. And let me clarify what I said before. It takes about a year and a half to 2 years to actually do it. We have plenty of time. Most of the people watching the show are mature. I don't want to use older.
That's right, heaven forbid.
I'm not going to do that. But we're a little bit older. And when I see something go from 10,000 to 45,000, put that into perspective. Ask, and I mean ask your financial advisor these kinds of questions. Hey, what have they really done? Do you think that's a little excessive? Maybe it's a little much for me because I've just turned 65. I don't know. If someone is 25 watching this, I really mean this. In 1974, I was so envious of Warren Buffett, but he was in a position to buy very inexpensive equities. If you're 25 and watching this, these are expensive prices. You have a tremendous opportunity coming up. Instead of saying, we're in for the long term, why don't we just sit back and say, we're in it to make money? I don't know what anyone else is doing this for. You're in it to make money. You don't make money when you buy at the high and you sell at the low.
Robert, what about Treasury securities? I mean, that was your specialty when you were running Kessler Investment Advisors.
One of the big fears in the market right now by a lot of people is that inflation will eat up interest rates in the future. Well, if you believe that, I personally don't. We live in
You don't, because you don't think inflation is going to be a problem?
Inflation has never been endemic. It's never been a part of a free market economy. If you're going to let the economy run free, everyone wants to sell it cheaper than the next guy. If it's cheaper than the next guy, it's not inflationary. The only time it gets inflation, look, we just went through a pandemic, $7 trillion to kind of bail out everyone, corporations, individuals, and individuals got all this money and we ran out and decided to spend it. Okay, that's understandable, except that the Chinese factories, the European factories, our factories, we didn't have anyone working. It was a pandemic. So prices went up. We're talking about tariffs at the moment. That's a little iffy. That's scary. So going back to the Treasury question, you can buy very short-term Treasuries, 3 months, 6 months, 9 months, a year Treasury. You're going to get 4.5%, 5%. Remember what these numbers, that's a good deal. This is a very nice way to sit and wait for the price to come down to where you're feeling comfortable. Not your financial advisor. He's always comfortable. It's his business.
You know, one of the objections will be, but Robert, what about the tax consequences of selling at these enormous capital gains? I'm going to have to pay a ton of taxes. And you actually told me that over the years, one of your big regrets was you actually listened to that argument. Why isn't that a valid argument?
Stop and think about it. I just bought the vase at Antique Roadshow, brought it in, and they just told me it's worth $20,000. I paid $2,000 for it. Oh, wait, I don't think I'll sell it because of the tax consequences. I have to tell you, I happen to deal a lot since I've retired and always in Chinese artifacts. Oh, and they always go up. They always go up until China has a problem. Suddenly, all of those buyers aren't there. But what about the taxes? Oh, I kind of wish I would have sold some of those things when they were all there. You're given an opportunity. This is not a tax question. It is the most boring question in the world. This is a question simply of profitability.
So at some point in the future, there is a possibility that you and Warren Buffett will get back in the market. We're just not there yet.
I hope I'm around to do that. I really mean that. And maybe I should stress that more than the sale of something. I should stress the opportunity to buy something. There is going to be a tremendous opportunity to buy something, and it'll be a period of time that no one wants anything.
One investment for a long-term diversified portfolio, Robert Kessler.
Short-term treasuries where I would park money. It pays you enough. And over the long term, 15 years, 12 years, you double your money. Sounds good?
Robert Kessler, thank you so much for joining us once again on WealthTrack for our 20th season. Delighted to have you on since the very beginning.
Well, thank you very, very much. It's been my pleasure the whole time. Thank you.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is design your portfolio with the worst 2% of market conditions in mind. That contrarian piece of advice comes from William Bernstein, neurologist turned investment advisor and author of the investing classic, The 4 Pillars of Investing, Lessons for Building a Winning Portfolio. It's now in its second edition. It was published 2 decades after the first and is a book highly recommended by many WealthTrack guests. In an insightful and succinct Wall Street Journal interview a few years ago, Bernstein discussed a major theme of the latest edition. It's a huge and usually fatal mistake to design a portfolio without focusing primarily on those approximately 2% of times that will cause you to lose your nerve and violate Charlie Munger's prime directive of compounding. As Munger, who is Warren Buffett's partner, puts it, the first rule of compounding is to never interrupt it unnecessarily. Now, Bernstein goes on to recommend holding plenty of safe assets like dull, low-yielding Treasury securities and being prepared to see your risky assets get periodically and hopefully temporarily slaughtered. Well, long experience has led Bernstein to conclude that it is better to hold a chunk of safe assets with their suboptimal returns than holding a ton of high-risk assets that most investors abandon in those worst of times. He sounds very much like Robert Kessler. Next week, award-winning financial planner Mark Cortazzo shares how he prepared for his own retirement. Please follow us on Facebook, X, and our YouTube channel. Thank you for spending time with us. Have a lovely weekend and make the week ahead a healthy, profitable, and productive one.